A very good morning. Hope you're having a good week. Wishing you a great Thursday ahead as well. Welcome to today's episode. Three things we will talk about. Fed stays on hold, earnings from Apple, and earnings from Facebook. US stocks tick lower Wednesday after Federal Reserve said it would stick to loose monetary policy that has underpinned the market's rally in the recent months. The S&P 500 slipped less than 0.1%. In fact, the index wavered between small gains and losses throughout the session, then retreated after the Fed held its key interest rates near zero and said that it would continue bond purchases to support the economic recovery. The Dow Jones was down by 0.5%, while the Nasdaq was down by 0.3%. Amid progress on vaccinations and strong policy support, indicators of economic activity and employment have strengthened. The Federal Open Market Committee said in a statement Wednesday after holding its key interest rate near zero and maintaining a 120 billion monthly pace of asset purchases. Marking a clear improvement since COVID-19 took hold more than a year ago, the Fed said risk to the economic outlook remain, softening from previous language that they used where they were referring to the risk as considerable risk. The statement also noted that sectors hit hardest by the COVID-19 pandemic had shown improvement, and on the risk of prices rising, policymakers said inflation has risen, largely reflecting transitory factors. Powell told a post-meeting press conference that the recovery has been faster than expected, but it remains uneven and far from complete, and the economy is a long way from our goals. The US central bankers repeated that they would not change the pace of bond buying until substantial further progress is made on their employment and inflation goals. The target range for the benchmark federal funds rate was kept at 0 to 0.25, where it has been since March of 2020. Powell said that it was not yet time to discuss scaling back asset purchases, and it will take some time before we see substantial further progress. So that was the FOMC and the Fed statement, pretty much the same tone that Powell has been maintaining over the last many months. On to earnings, Boeing shares fell 2.9%. The aircraft maker reported its 7th consecutive quarterly loss and booked a charge on its work replacing Air Force One. Spotify Technology shares slumped about 12% after the music streaming company said user growth had softened in the first quarter. Pinterest tumbled 15% after social media company added fewer users than analysts had expected. Texas Instruments was down 4.4% after the chip maker said it expected second quarter revenue to be less than what analysts were forecasting. Moving on to the two big reports that came through. Apple signaled that the historic rise in sales it has achieved during the pandemic is set to continue, addressing a key investor concern as the company reported record revenue in the first 3 months of the year. New, more expensive models of the iPhone 12 have been hit with customers. The revenue from Mac computers and iPads also rose during the quarter on strong demand from employees and students conducting their work at home. Apple's fiscal second quarter results set new highs in what could very likely be a record-setting year for profit and revenue. Analysts predicted full-year profit will exceed $70 billion, nearly a third more than last year. Shares jumped more than 4% in after-hour trading. The company reported its profit more than doubled to $23.6 billion in the latest quarter of $89.6 billion in revenue, far exceeding the Wall Street expectations. The company also announced a 7% increase in its cash dividend to 22 cents a share, and the board also authorized an increase of $90 billion to an existing share repurchase program. Much of Apple's growth last year was fueled in unexpected places. The company saw record demand for Mac computers and 11% rise in iPad tablet sales. That growth continued in the March period as well. On Wednesday, Apple said Mac sales rose 70% to 9.1 billion and iPads increased 79% to 7.8 billion. That beat analysts' expectations for an increase of 27% and 29% respectively. The real engine still remains the iPhone. Overall iPhone revenue rose 65%. Analysts had expected a 42% rise. The addition of faster 5G cellular connections to this year's phone was expected to help Apple in China, where competitors had beaten Mr. Cook to market with more advanced phones. Greater China sales nearly doubled to 17.7 billion. It's phenomenal the kind of numbers that Apple came out with yesterday. Not to leave services behind, services generated a record 16.9 billion in revenue, topping estimates of 15.6 billion. Late last year, Apple rolled out Apple One services bundle and new offerings such as the Fitness Plus workout offering. There are some subtle changes that Apple has made to their ad policy as well. I'll speak about that tomorrow because it's a pretty interesting and an important development according to me. Lastly, on Facebook posted a sharp increase in quarterly revenue and profit as it benefited from a wave of digital ad spending, but said it expects growth to slow later this year from factors including Apple's new ad targeting rules, which is what I mentioned to you a bit earlier. The social media giant said Wednesday its first quarter earnings report reflects the past year's trend of people spending more time and more money online and advertisers redirecting their resources to take advantage of that shift. The parent of Facebook, Instagram and WhatsApp said that the average price per ad and the number of ads it delivered during Jan through March period increased. Advertising revenue, which accounts for a lion's share of Facebook's total revenue, rose 46% from a year earlier to 25.44 billion. The company's profit nearly doubled to 9.5 billion or $3.3 a share. Shares rose 5% in after hours as both total revenue and profit beat Wall Street forecasts. That's the update. Such a loaded week this week. So I hope we can take it light for tomorrow, but let's see. Take care and I'll speak to you tomorrow.